This Monday morning, you're waking up to a crude oil market that doesn't exist anymore. Friday's close at $76.01 is now a ghost. Over the weekend, Iran expanded attacks on Gulf states and announced the Strait of Hormuz is closed. That's 20 million barrels a day offline. A supply shock this large rewrites every support and resistance level on your screen. Most traders will look at the chart and buy anything that moves, chasing the first spike like it's free money. And that's exactly where the trap sits. This week has one danger zone, one liquidity vacuum, and one 3 to 5 day opportunity that could deliver the entire geopolitical move, if you don't become exit liquidity in the first 2 hours. I'll show you both Monday scalps, the swing trade that can run until Friday, and the one level that decides whether this week is a $90 melt-up or a collapse back into the low 70s. Stay to the end. You need the full blueprint, and I'm putting the exact numbers on screen, instant weekly verdict. My 3 to 5 day structural bias. We are in a violently bullish repricing phase that will attempt to hold a trend reversal, but the entire week lives inside a massive gap. The trend before the news was a strong sell. Weekly, daily, 4-hour, all pointed lower. MACD deeply negative, stochastics buried at 18, ADX above 45 screaming strong directional move, and price was holding below every major moving average. The 200-day sat at 76.49, and we closed just beneath it. That clean downtrend is now being body slammed by an exogenous shock. The key pivot for the next 5 days is the Monday opening range. Write this number down, $85. If we open above 85 and hold it for the first hour, the melt-up chase is on. If we open above 85 but then slam back below by the London fix, this becomes the most epic stop hunt of the quarter, and the trapdoor leads straight to 75. The herd is positioned exactly wrong coming into this week. CTAs were short, managed money had net short exposure, and options dealers are short gamma near 80. A gap into the 80s will force a massive covering rally that feeds on itself. That's the engine for the upside. But here's what most won't realize until Wednesday. The CPI print and a week of heavy earnings can introduce a demand destruction narrative exactly when the supply panic is peaking, and that's where the reversal risk lives. Let's go to the charts. On the weekly time frame, we've been in a strong sell structure, with the 20-week moving average up at 86.15 acting as a ceiling. Price hasn't touched that level in weeks. The MACD is still in a bearish cross, but this kind of event can produce a hidden bullish divergence if we close the week above the 20-week. That's the structural shift I'm watching. If by Friday we sit above 86.15, the monthly trend, which is currently neutral, turns bullish with momentum. The weekly support that mattered, 73.80, the prior resistance turned resistance, is now 100 miles beneath the gap, unlikely to be tested this week unless we get a total invalidation of the shock. The real weekly resistance after the open will be the psychological 90 handle, which aligns with the prior structural level from the 2024 conflict spike. This week's range is likely to be between the open gap around 85 and a stretch target at 95, with 90 as the battleground. Drop to the daily chart. Before the weekend, the 50-day moving average was at 81.24 and the 100-day at 78.44. Both were sloping down and acting as dynamic resistance. Monday's gap will slice through both of them like they don't exist. So the first real daily support that traders will try to lean on is the breakout retest of that prior resistance area, specifically the 80 to 82 zone. That's where I'll be looking for a swing entry later. MACD on the daily has been rolling over negatively, but a gap open will immediately flip it to a bullish crossover on the histogram, a signal that can trap momentum chasers if the rally fades. This is why I say, the first 2 hours are a minefield. Now the 4-hour and 60-minute are useless before the open because the gap resets everything. But once the first 4-hour candle prints, I'll be watching the high of that candle as the intra-week bias anchor. If the first 4-hour candle is a massive bullish Maribozu, closing above 90, the melt-up is real. If it's a doji or a wick-heavy rejection at 90, that's the fade signal for the Monday scalp. Here's what most traders will miss until Wednesday. The correlation with S&P 500 futures. A $10 spike in oil normally crushes equities because it screams stagflation. But if S&P 500 futures gap down and then recover with oil still elevated, it tells you the market is treating this as a contained geopolitical event, not a systemic demand crisis. That cross-asset linkage will be the tell for whether the oil swing can extend into the end of the week. So keep one eye on the ES futures. Hidden divergences on the weekly timeframe are where the real money is made. The weekly RSI is at 43, nowhere near oversold, which means there was still plenty of downside fuel before the event. But the weekly stochastic is buried at 1855. That's deep into oversold territory. When an oversold weekly stochastic gets a supply shock catalyst, it can generate a rapid, violent bullish crossover. That's a signal that doesn't print often, and when it does, it can carry price 2 to 3 weeks. If we close this week above 86.15, the stochastic will cross positive, and that's a weekly buy signal that swing traders would ride for a $10 move. On the MACD front, the weekly histogram has been compressing to the downside, and if we get a sharp reversal bar, we'll see a bullish divergence with price, a lower low in price before the news, versus a higher low in the MACD line. I'll be watching that Wednesday once we have a few daily closes. The danger is a false stochastic cross that whips back down if the Strait reopens suddenly. That's the geopolitical wildcard that could snap the crude oil weekly forecast right back to the 70 area, now the fundamental driver and the weekly calendar. The Strait of Hormuz closure is the headline, but the market will immediately start pricing in how long it lasts. 20 million barrels a day is roughly 20% of global oil supply. Every day this remains closed, we lose a buffer that already had OECD inventories drawing. Weekend institutional flows will show massive call buying in the June and July Brent options, targeting 100 strikes. ETF flows into USO and BNO are going to explode at the open, adding to the front-running pressure. So day 1, Monday, is a purely supply panic session. Tuesday we get the API inventory numbers, which will be stale because they reflect last week's data, so expect a fake reaction. The week's fuse is Wednesday. We have US CPI, plus we have EIA crude inventory data on Thursday due to the Monday holiday. Wait no, the calendar says packed week of earnings, CPI, Iran headlines. I'll lay out the high-impact days. Monday is pure headline risk. Tuesday the attention starts shifting to the demand side with some earnings like Delta that give a macro read. Wednesday CPI is the market's obsession. A hot CPI with oil spiking equals instant recession fear. That's the moment oil could reverse hard. Thursday and Friday bring continued Iran headlines and potential de-escalation rumors. So my 1 to 2 week directional lean is bullish for the front part of the week, but I'll be ready to fade any failure at 90 and then go flat ahead of CPI if the swing hasn't triggered on a pullback. The exact event that invalidates the bullish weekly thesis is a verified de-escalation, even a rumored ceasefire that reopens the Strait. That would send Brent below 73.80 within hours. Here's your second interaction trigger. Do you think Brent closes above 90 this Friday? Comment yes or no in the chat. I'm tracking consensus to see if the crowd is too bullish or too skeptical. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching because the 2 Monday scalp plays and the swing trade I'm about to give you are built for this exact type of manic Monday. They are not guesses. They are engineered around liquidity and gap mechanics. And I'll display each trade plan on screen so you can screenshot it. Strategy 1, the Monday opening scalp. We are calling it the fast snipe. This is for the first 1 to 3 hours after the London Open. The trigger condition. After a huge gap open that pushes price to the 85 to 88 zone, we wait for the first pullback and a 5-minute reclaim of the initial balance high. Here's the exact plan. Let's assume the open prints a high at 87.50 and then dips back to 84.80. If price holds above the 5-minute 20 EMA and pushes back above 86.20, that's the trigger. Entry at 86.25, stop loss at 85.50, so a tight stop below the pullback low. Take profit 1 at 88.30, which is the opening range extension. That's a quick 1 to 1.6 risk to reward scalp. What instantly voids this scalp? If the first 15-minute candle closes back below 85, the gap fill is in play and you don't chase the Monday opening SCLP entry, 86.25, 5M bullish reclaim above opening pullback high, stop loss, 85.50 take profit 1, 88.30 risk, reward, 1:1.6 invalidation, void if first 15-minute candle closes below 85.00 strategy 2, the Monday liquidity grab. This is the counternoise scalp, my favorite. Friday's high was around 77.30, but that's irrelevant post-gap. Instead, the Asian session will create a new range. The liquidity grab will occur if price spikes through the early session high, say $90, then violently reverses. We are looking for a false breakout above a big round number that stops in retail longs and then snaps back. Entry, after a 5-minute close back below 89.80, short at 89.75. Stop loss above the wick high at 90.20. Take profit 1 at 88.20, which is the midpoint of the spike. Risk to reward here is about 1 to 2.5. Warning, this requires aggressive execution. You must be ready to hit the button when that false breakout candle closes. Hesitation kills it. On-screen graphic, the Monday liquidity GROB entry, 89.75, short on 5M close below 89.80 after false break above 90, stop loss, 90.20 take profit 1, 88.20 risk, reward, 1:2.5 invalidation, void if 5M candle closes back above 90.10. Are you scalping Monday or swinging the week? Comment scalp or swing right now. Let's see who's built for this market. Strategy 3, the 3 to 5 day swing. This is the core trade of the week, aligned with the melt-up scenario. I want to buy a pullback into the gap fill zone, targeting a multi-day run toward 95, capturing the trend reversal that the weekly stochastic suggests. The entry condition, we need a daily close above the 50-day moving average, which will likely be around 81.20, but with the gap that's already happened, the more precise trigger is a pullback to the 81 to 82 zone and a 4-hour bullish engulfing candle. So the plan, place a limit order at 81.80, which is the confluence of the prior daily resistance and psychological even number, stop loss at 79.50, below Friday's close and below the prior weekly pivot area, protecting against a full gap fill collapse. Take profit 1 at 89.80, just under the 90 magnet, for midweek booking. Take profit 2 at 94.50, the stretch target if the Strait stays shut through CPI. Risk to reward, 1 to 3.5 on the first target, 1 to 7 on the second. Once price reaches halfway to TP1, at around 85.70, I'll trail the stop to break even and then to the 4-hour 20 EMA. The explicit invalidation, a daily close below 78.20. That would signal the shock is fully priced out and the weekly sell trend resumes to 3 to 5 days to NG entry, 81.80, limit order on pullback, confirmed by 4H bullish engulfing, stop loss, 79.50 take profit 1, 89.80 take profit 2, 94.50 risk, reward, 1:3.5 or 1:7 are invalidation, void if daily close below 78.20 risk management pulse. Never risk more than 1 to 2% per trade. This week, the ATR has exploded. Stops must be wider or position size must be halved. Holding through Wednesday's CPI means you accept a potential $5 intraday swing on a headline. Stops are non-negotiable, especially on the swing. If the Strait reopens on a rumor, you'll be thankful for that hard stop. This is how you survive to trade the next big weekly move. The single most critical level for the entire week is $85. A close below 85 on the daily chart signals the supply shock is being absorbed and the trap is set. Above 85, the melt-up narrative builds into Friday. If we break and hold above 95 on Friday, the monthly trend flips bull, and I'll have the updated blueprint for you this Sunday. Tease that Friday finale. A possible Friday afternoon de-escalation rumor could see a $10 crash in the last 2 hours. That's your wildcard risk. So manage your swing accordingly. If you want last week's Brent Crude recap to see how we mapped the downtrend before this shock, that video is live now. Tap the end screen. Then hit the bell so Sunday's next week ahead alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week. I'll see you in the next video. Trade smart, stay ahead.